Hey, welcome to Everyday Economics. This is the podcast that helps you understand the economic world going on all around us. Everyday Economics is brought to you by the Center Square Newswire service. I'm Chris Krug, publisher of the Center Square. Orphe Divounguy is my partner and co-host. He's a PhD economist. Today is Monday, April 13th, 2026. In this episode, we're going to talk about the chain reaction that starts at the gas pump and ends at your mortgage rate and why the housing market hasn't cracked yet, even though the math says it should have. We put a 10-minute timer on every episode of this show, so we keep it crisp for you. So let's get into it. Orphe, the Everyday Economics column this week laid out the March inflation numbers. Consumer prices up 3.3% year over year, up 2.4% in February. Gas alone surged 21% in 1 month and accounted for nearly 3/4 of the headline increase. That you've been making a point that all inflation is not the same. When gas prices drive 3/4 of the monthly increase, what kind of inflation are we really dealing with? And why does it matter that the Fed basically can't do anything about it?
Yeah, we kind of talked about it on the previous show, and really, you have two types of drivers for inflation. You either have demand pull inflation, which is basically, hey, people have more money in their pockets and they go out and spend, and so as they spend, they push prices up, and it shows up in higher inflation. This is not what we're seeing, right? In the first case, in the case of demand-driven inflation, the Fed can actually kind of tighten policy, make it difficult to borrow, and essentially curbing spending, right? Private spending. In this case, we had a supply shock, right? Higher interest rates will not produce more oil. They won't reopen the Strait of Hormuz. And so there isn't very much the Fed can do. In fact, this is the kind of inflation that kind of punishes consumers and doesn't give policymakers any real options. If the Fed raises interest rates in this environment, it could actually make matters worse because it will actually punish businesses, households, and businesses.
Yeah. So, all right. So you said in your column, really, I mean, I think directly, that the Fed can't fix this. And I hear you. But the person who's listening or watching us right now doesn't really care what kind of inflation this is. Their grocery bill is up. Their gas bill is up. At what point does the type of inflation stop mattering to the family just trying to make ends meet?
Well, it matters right now. Again, the oil prices are up. And eventually, oil prices will kind of feed into prices of other things, right? Yeah. And we're already seeing it with higher interest rates as well. As inflation moved up, interest rates went up, mortgage rates went up. It's really affecting households. But the Fed just can't help right now, right? Yeah. Because if the Fed were to lower interest rates to help support households, well, then it could actually exacerbate the problem on the inflation side, on the inflation front. If inflation expectations become what we call unanchored, basically people start to expect that prices will continue to rise and will rise even more in the future. People will go out and buy groceries today. They'll load up on gasoline today, which will drive prices even higher and actually cause even more pain on most households, especially those at the bottom of the income ladder, for who basically, food, gas makes up a much higher share of their budgets.
Yeah. Okay. All right. That makes sense. So here's kind of what surprised me in your column. And this is a data point. Private sector market reports are showing nearly 282,000 people, newly pending homes listing in March. That's up about 5% year over year. That's the second best month since August 2022. Inflation is spiking, hiring is slowing, real wages are getting squeezed. So why hasn't the housing market broken?
Yeah, I think that ultimately, and we're going to get some existing home sales data this week from the National Association of Realtors. But ultimately, people are the housing market is being very resilient, right? You're starting to see the seasonal uptick in activity. But ultimately, the uptake is not high enough to surpass year-ago levels. So you're still seeing less than expected housing activity. We started the year expecting even more activity than we had a year ago. Remember, the newly pending sales number is good, but some newly pending homes don't actually close. So, positive sign, but the big question is, will it last, right? Like you said, inflation's higher, hiring is slower, the labor market has softened, wage growth has slowed, mortgage rates are higher. The big question again is, what as we get beyond this month of March, are we going to see that persist, or will we see kind of a slowdown, bigger slowdown now starting to show up in housing? Remember, the longer the shock lasts, the more difficult conditions are going to become, the tighter financial conditions are going to get. And so essentially households could be forced to pull back.
Yeah, and it was an eventful weekend. Of course, we're taping this on Monday, April 13th, and Vice President J.D. Vance came back from the conversations in the Middle East, and Iran couldn't get there with the plan that we had mapped out. So I'm not saying that the peace talks have totally collapsed, but we're kind of in this strange sorting out period. So let's take a totally optimistic assumption off the table and deal with what might actually happen. If energy prices stay elevated through the summer, what does that do to the housing market? And what does it do to the person who was planning to buy their first home this year?
Yeah, I think ultimately all the uncertainty, the first, the mortgage rates are higher, right? Good news is they're still lower than they were a year ago, so that's a positive. But ultimately, hiring is slow. Hiring rates are the lowest they've been since 2011. There are fewer job openings. There are job seekers today. The labor market has slowed down. One of the top reasons people move is a new job. And so if there are no new jobs being created, if there's very little upward mobility, if real incomes continue to erode, if confidence continues to dance along the bottom, people could actually kind of skip out this year, right? You're seeing it already on the high end. If you look at luxury real estate, there are fewer new listings this year, fewer sellers. People are just higher end consumers, at least in the housing market, are kind of just choosing to sit this one out, right? And so if things continue to, don't improve or even worsen, we could end up seeing kind of a bigger slowdown than we had in housing, than we had in the past 2 years in housing.
Yeah, I mean, that's the thing about economics. The person at the margin is always the one who, ultimately, feels it first. And that's just reality, right? I mean, Dr. O, thank you. We'll be watching the existing home sale numbers and the Builder Confidence Index this week, and we'll be back with what they tell us. Make sure that you read Orphe's Everyday Economics column every Monday in the Center Square, and listen to what we have to say every weekend on the Center Square Radio Hour.